This is Horizons Middle East and Africa. Our top stories this morning. President-elect Donald Trump vows to impose additional tariffs on China, Canada and Mexico, saying they need to clamp down on migrants and illegal drugs. The dollar rises and Asian stocks drop on the prospect of an additional 10% levy on Chinese goods and 25% on North America's regional neighbours. Plus, Israel and Hezbollah are inching closer to a ceasefire deal that may be concluded in the coming days. In the meantime, the two sides continue to fire artillery and rockets. It has just gone 8 a.m. across the Emirates. It's 3 o'clock Monday afternoon here in Sydney. I'm Paul Allen in for Jemima Besetche. Let's take a look at how markets are tracking at the moment. We've got Russell futures trading a little bit to the downside. Now, that's worth watching. We did see the Russell 2000 index surging 1.5% in the last session in the US. It's getting close to a 3-year record. So those small cap stocks have been performing pretty well, although it's going to be interesting watching some of these riskier trades once the US opens on the news of these additional tariffs that the incoming Trump administration plans to level. We'll get a little bit more on that in a moment. Connected to that, we have seen the US dollar surging as well. The dollar spot index getting close to a 2-year high now on that tariff threat. An additional 10% tariff, of course, on goods from China. That's additional on top of anything else that might get imposed. Now, what you're seeing there is a chart of the Treasury curve, the 2s, 10s curve, reinverting. That's something we haven't seen for a couple of years now. Briefly reinverted. We do have bets that Scott Bessent's incoming Treasury Secretary may be softening Trump's somewhat hawkish plans. That's been sparking a rally in US Treasuries, particularly when it comes to the long end. So let's take a look at how markets in Asia are faring on a day of some pretty interesting news flow. Avril Hong's in our Singapore studio. Avril.
Absolutely. Paul, you get the sense that it has begun. It's a foreshadowing of what we might get the next 4 years. It's really headline-driven kind of market trading. We're seeing today Asia stocks mostly lower. We are seeing Chinese shares managing to go into the lunch break with gains, though. It's really interesting how they've managed to reverse from earlier declines. And some have already pointed out that, the tariff plan might just heighten expectations of fiscal stimulus from authorities, a positive for stock markets, but also the idea that when it comes to Trump's tariffs, there's room for negotiation. So really about the implementation ultimately. Are we going to see it beyond the rhetoric? And that is what we're seeing in Chinese stocks, but also wanted to highlight what we're seeing in the Chinese yuan. Dollar onshore renminbi is sitting above the 725 level. And as some of our colleagues have highlighted, that's a sort of line in the sand that Chinese authorities have been guarding for this month. So interesting to see how that's playing out as well. Paul.
All right, Avril Hong there in Singapore. Well, President-elect Donald Trump has threatened more tariffs on China, Canada and Mexico, citing concerns over migrants and illegal drugs. Let's bring in our chief North Asia correspondent, Stephen Engel. So, Steve, there's going to be an additional 10% on top of anything else. What more do we know about this?
Well, he's getting a jump start on his second term in the White House, obviously, that begins January 20th. And this is somewhat separate from the trade tariff pledge that he made on the campaign trail of across-the-board 60% tariffs on Chinese imports to the United States. That's on top of course, the 25% tariffs on more than $300 billion worth of Chinese goods that he imposed in his first term, and the Biden administration did not rescind. So this would be an extra 10%, according to his Truth Social postings this morning here in Asia time, which did initially, of course, rattle the markets. And again, this is in response to what he says is the lack of action by China that have been pledged by, Xi Jinping and Joe Biden met in San Francisco on the sidelines of APEC. They came to an agreement that China would crack down on fentanyl. The precursors, not necessarily admitting that they were facilitating that illicit drug trade through Mexico. But again, there was agreement that they need to all combat it. Donald Trump is using some very sharp words to essentially say China has not followed through on its promises, and if they do not take action in the next 2 months, he will impose that additional 10% on China. Now, separate to this, Paul, as Avril just ran through, is the tariffs on the two closest neighbors of the United States, the southern border, Mexico, and the northern border, Canada, 25% tariffs if they do not combat the illicit transfer of drugs across the border in the south, even to the north, as well as illegal immigrant crossings. So it sets the stage for a rocky beginning with its closest allies in the northern hemisphere, obviously Mexico and Canada, but also China, the three biggest trade partners of the United States, and what that will potentially do to supply chains in the automobile sector, also oil shipments to the United States from Canada, and inflation, no doubt.
All right, Stephen Engel there in Hong Kong. Thanks for joining us. Well, let's bring in Manpreet Gill now, Standard Chartered Wealth Management CIO for Africa, Middle East and Europe. Manpreet, one thing we can remember from the first Trump administration is its capacity to surprise. We haven't had a lot of reaction from Chinese stocks. They're actually in positive territory now. Was this sort of thing priced in, do you think?
Well, I think what we've got so far is perhaps for markets less of a surprise. I mean, the indications were there not only in Trump's platform going into this, but by his cabinet appointments. If you think about his various secretaries of the departments. So for financial markets, I think tariffs were always well known that they were in the pipeline. The question only was one of how quickly and by how much, and we're starting to clearly get some indications of that. I think for markets, less of a surprise for Asian equities. I think it's the dollar where there might be room for a little bit of repricing. We have got a break above, the range we've been in for about 18 or so months. So I think that's the one asset class which actually looks interesting and possibly one that's moved into a slightly higher range as a result of pricing in the tariffs. But for Asian equities so far, perhaps less of a surprise, and at least nothing that wasn't priced in already.
Well, let's talk a little bit more about that move that we've seen in the dollar. We've got the dollar spot index pushing towards 2-year highs now. Can it go higher from here? And which of the currency pairs do you see being the main losers going ahead?
I think in the short term, we absolutely can. I think, like I said, the break higher, I think, is what's created some short-term momentum. And, if you take a purely technical view, for example, 110 is not that far away. I do think we will get a bit of a pullback. We're right now in the process of pricing in earlier sort of the rebound higher in bond yields and now the tariff news. And I think once that's priced, we will see a bit of a pullback lower towards 104 or so. But that does put us in a higher range. I think in terms of currency pairs, look, the euro will most probably still bear the brunt of it, not only because it tends to be the default anti-dollar pair, but because that's where a lot of the interest rate differential and growth differentials are sharpest, particularly some of the weak data out of Europe. So that's perhaps from a pure FX market, the first place we'd look. Obviously, with some of the EM currencies that are the targets of Trump's latest announcement. So CNH, we've always been of the view that, a move towards 730, not too far away from here, but still slightly weaker for CNH. That's one likely reaction of tariff news, but obviously, of course, on the Mexican peso, which, again, to some degree had already priced in a large probability of this around the election, perhaps the tail end of that pricing now likely to occur.
We also pointed out at the start of the show some of the interesting moves that we've seen in US Treasuries as well. The 2s, 10s yield curve briefly reinverting. What's your feeling on yields? Do you think they've peaked for now?
In the very short term, they might have. And after that test of about 4.5, 4.6, creating a bit of a wobble in equities, that's most probably the short-term ceiling for now. It's harder to read into what to make of the reinversion of the yield curve. The traditional economics view is reading the yield curve as a recession indicator. We now know, at least in the last couple of years, that's not worked so well. For investors, I think the real takeaway here is take advantage of rebounds in yields. So that's perhaps not right now. But as we had that push towards 4.5, which could very well repeat, the real opportunities to move out of cash into longer, sort of mid to longer maturity bonds. Because while the 10-year might fluctuate in this 425 to 450 range short term, is cash yields that will continue to move lower as the Fed sort of chips away at 25 basis points each quarter. So we think that's the real investment decision. And we think that cap, of course, improves the outlook for equity markets. And I think there for us it's a US story still, where we expect, outperformance relative to the rest of the world.
Yeah, I know you say remain overweight US tech, but do you get in at these prices? It is quite expensive.
It is, and that's why it's no longer just about US tech. I think first and foremost it's more about US equities relative to a lot of other regions, perhaps more so relative to Europe, where the growth outlook is perhaps at the polar opposite. So that to me would be the first place to start. And then of course the sectors, and I think tech and communication services are one. Valuation is absolutely a challenge, but that's also where earnings growth is highest. That's where the dominant theme in markets is today. But the other one we'd start adding on is financials, because we do see sort of more support from yields, but more importantly, an extension of the growth cycle. So improved sort of credit demand, credit quality. We think that, of course, can really help support the financial sector, and that'll start spreading your bets away from just the tech sector rally alone.
And how about non-US markets? What opportunities do you like there?
More pockets, and I think in Asia, it's still Indian equities is the one we like. I think Asia, we're sort of more neutral or core holding across the board, but I think Indian equities is where we're still more confident about the growth outlook. I think there's more confidence there. A little bit of softness recently in the numbers, but I think we've got an interesting pullback that's created a long-term buying opportunity. I think that's sort of the growth area we prefer. Chinese equities, of course, still offer pockets of opportunity, and I think we'll have to obviously go through this tariff discussion. But for example, we have, a large part of this year, we still like high dividend SOEs outside of the financial sector. So there are many sort of more focused opportunities, particularly in Asia. But I think at a market level, it's Indian equities the one we'd use these sort of pullbacks to add some long-term exposure.
All right, Manpreet, thank you so much for your time today. Manpreet Gill there, Standard Chartered Wealth Management CIO for Africa, Middle East and Europe. Still to come, Israel and Hezbollah inching closer to a ceasefire deal that may be concluded in the coming days. We'll have the details of that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. Israel and Hezbollah are inching closer to signing a ceasefire deal that may be concluded in the coming days. However, the two sides do continue to fire artillery and rockets at each other. Israel's Security Cabinet is expected to vote on an agreement later on today. Paul Wallace leads Middle East and North Africa economy and government coverage, joining us now from Dubai. So, Paul, how close are we to a ceasefire deal?
Hi. We certainly do seem a lot closer than we were a week ago, and there's quite a bit of optimism now from the Americans and also a lot of Israeli officials. The Security Cabinet meeting today is going to be quite important. If Prime Minister Benjamin Netanyahu can get enough support for a truce agreement, then it will go back to the deal will go back to Lebanon essentially, and as far as Israel and the US are concerned, Hezbollah will agree to it in a shortly after that. So we could be on the cusp of a deal. I do have to say there are still some obstacles to overcome, and we've been here before, especially when it comes to Gaza. Several times we've had Americans and others saying we're on the cusp of a deal, it's very close, and it hasn't happened. So there's still a lot that could go wrong.
Yeah, plenty of false dawns. In the background, though, we've also had the central bank deciding to hold rates. What does this say about the state of Israel's economy?
Well, I think it tells you how much strain the economy is under. So rates were held at 4.5%, the seventh straight hold by the Bank of Israel. In an ideal world, it would be cutting, joining the global monetary easing cycle. However, inflation is above target. It's at 3.5%, which is above the top end of the target of 3%, and that's because of the war. At the same time, the wars are slowing the economy, so the central bank has to weigh these two different things. things. And in its communique yesterday, the Monetary Committee constantly referred to the conflicts and to the geopolitical situation as the biggest factor determining what it does. So I think yesterday's decision showed you how much strain Israel's economy is under because of these wars with Hezbollah and Hamas.
All right, Paul Wallace leading Middle East economy and government coverage. Thank you. Let's get to our next guest now. David Wood is Senior Lebanon Analyst at the International Crisis Group and joins us now. David, we're just hearing from Paul there saying that we are close to a deal, but of course, we've been here before. What are the risks this not happening, and how much confidence do you have that we'll have something agreed to?
So, as your correspondent mentioned before, we have been here, not just in Gaza, but also in Lebanon, where we've come to the verge of what seems to be a ceasefire agreement, only for it to fall over at the last minute. However, this time does feel different, especially because it seems as though a critical mass of Israel's leaders seem to be on board with this. And later on today, there will be an Israeli Security Cabinet meeting at which the deal will be considered and potentially approved. So that is an encouraging sign, but it is worth noting, however, that there is still opposition to the deal inside Israel. And this comes not just from, for example, Ben-Gvir, one of the far-right ministers in the Netanyahu cabinet, but also from many of the displaced Israelis from northern Israel themselves, who believe that it would be better for Israel to continue to attack Hezbollah and to fully degrade its military capacity rather than reaching for a ceasefire now.
Yeah, the National Security Minister is one of those people. He says that, as you say, Israel's missing a chance to crush Hezbollah here. Who needs this ceasefire more, Israel or Hezbollah?
Well, again, as your correspondent mentioned, Israel is under a lot of pressure now. We know that the situation in Lebanon is truly dire. There are more than 3,500 people who've been killed during the war. Around 15,000 have been injured and more than 1 million displaced. So clearly a ceasefire is an urgent and desperate need in Lebanon. But also Israel faces not just difficulties with its economy, which is being dragged out by the war, but also the fact that it's fighting a war on multiple fronts. There's issues in Gaza, there's issues in the West Bank, and there's also the war campaign in Lebanon. So I think there's incentives on both sides to bring this conflict to a close and to move towards a ceasefire and to find a negotiated political settlement which moves away from the logic of violence and towards the logic of negotiation.
Well, Hezbollah previously said that it wouldn't stop attacking Israel until there was a ceasefire in Gaza, and obviously we don't have that precondition met. So what's changed? Is it some of the factors you've described, or also Hezbollah's not going to go away? What does it take away from this conflict, and what does it do going forward?
I think that Hezbollah has now reached a point where it has abandoned the condition that it would only agree to a ceasefire in Lebanon if there was a ceasefire in Gaza. That much is pretty clear by now. And also with Hezbollah, I think that what it has seen is that it perhaps has reconstituted its military capacity enough after a disastrous past couple of months to the point where it could cause a bruising stalemate for both sides, especially in terms of Israel's ground invasion into southern Lebanon. So it feels as though as long as it can continue fighting back against the ground invasion, and as long as it can continue firing rockets and missiles into northern Israel, it has a place at the negotiating table. And that means that, as we're seeing, Israel is perhaps moving to the point where it prefer to reach a negotiated settlement rather than to continue to attack Hezbollah, given that its apparent aims of destroying Hezbollah as a military threat would be incredibly difficult to achieve and is already coming at a great cost to Israel's military, its economy, and its public.
Well, let's assume that the ceasefire deal does get agreed to. It's going to require monitoring. One of the preconditions that seems to be on the table is Hezbollah brings no more Iranian-supplied weapons into Lebanon, and Israel wants to reserve the right to restart hostilities if that happens. It sounds like there's a lot of risks here in terms of the durability of this deal.
Absolutely. And we need to note, of course, that it's not a permanent ceasefire. It's a 60-day ceasefire with the potential to become permanent based on what happens in the coming 2 months. I think that this deal can work if both sides genuinely want it to. So, as you point out, there will be a monitoring committee to ensure that Hezbollah withdraws from south of Litani River, so near the Lebanese-Israeli border. Now, Hezbollah would need to do this in good faith, because while the Lebanese army will be responsible for implementing this ceasefire agreement with support from the UN peacekeeping force UNIFIL, there is no way that the Lebanese government would deploy the Lebanese army to get into armed confrontation with Hezbollah. And similarly, as we mentioned earlier, there is some political opposition inside Israel to reaching this ceasefire agreement. So during this 60-day period, Israel, first of all, should not succumb to any of this political opposition and should instead press forward with the logic of negotiation. And also, as you mentioned, there's this question about Israel insisting on its right to act militarily if it perceives a threat from Hezbollah. But we still don't have clarity on exactly how that will work. Can Israel make that decision unilaterally, or does it need to go through the monitoring committee before it can do such a thing? In any case, it would need to be a commitment from both sides, a genuine commitment to ensure that this ceasefire works and that we can get to a permanent ceasefire in 60 days.
All right, David Wood there, Lebanon senior analyst at the International Crisis Group. Thanks so much for joining us. Coming up, Bloomberg learns that Qualcomm's interest in buying Intel has cooled, upending what could have been one of the biggest tech deals of all time. We'll have details of that scoop later in the hour. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. Let's take a look at how futures are trading ahead of the US session getting underway in a few hours' time. We do have a bit of a mixed picture at the moment, flat to slightly better, I guess. Nasdaq futures the best performing there. And of course, we have had the news today that incoming President Trump's threatening an additional set of tariffs on some of its largest trading partners, China, Mexico and Canada. We've got an oil price which is recovering slightly. It's still off about 2.5% over the past 2 days. We have seen oil easing a bit on optimism of the ceasefire deal between Israel and Lebanon. The Trump administration is also working on an energy plan, and that would mean a big ramp up in US drilling. We've also had a brief re-inversion of the US yield curve. Particularly in the long term, looks like we may have reached a peak for yields. Coming up, services drives an unexpected beat for Nigerian GDP. We'll have the latest on the West Africa nation's economy next. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. President-elect Donald Trump vows to impose additional tariffs on China, Canada and Mexico, saying they need to clamp down on migrants and illegal drugs. The dollar rises and Asian stocks drop on the prospect of an additional 10% levy on Chinese goods and 25% on North America's regional neighbours. Plus, Qualcomm's interest in buying Intel said to cool over complexities. It's just gone 8:30 a.m. Monday morning across the Emirates. It's 3:30 Monday afternoon here in Sydney. I'm Paul Allen in for Jemana Versace. Let's take a look at some of the assets that we're tracking. I want to have a look at Russell 2000 futures. The index of small caps had a pretty good run in the US over the past month. That index has been up about 8%, but we are anticipating a bit of pullback when we get going in the US later on. Of course, the news of additional tariffs from the incoming Trump administration might have some unintended consequences for some of those small manufacturers. Of course, a number of parts crisscross the border between Mexico and Canada on their way to becoming a car. Taking a look at some of the other assets there on the board, Brent crude having a bit of a rebound. We have seen crude prices slipping on the news that the Trump administration is also working on an energy plan, which would see a big ramp up in the US drilling. And the US dollar, well, it's having a terrific day on the news of those potential tariffs. The dollar spot index closing in on a 2-year high. Well, let's check in on what all of that means for markets in Asia. Avril Hong's in Singapore. Avril, what are you watching?
Yeah, that terrific day for the US dollar is playing out in Asia currencies, but stocks as well. And it's really interesting to see how on a day like that, Chinese shares are sort of defying gravity. But you're seeing the pain really come through on the Japanese gauges. Nikkei topics down by almost 1.5%. And I think some of our colleagues have been writing about this on the MLive blog, that Trump is wasting no time in suggesting that he has no qualms in upending global trade norms. And that's going to be pressure potentially on some of these export-related names in Japan, particularly the ones with a lot of overseas exposure. And another headwind for them coming in the form of the Japanese currency today, dollar yen sitting well below 154. And this is defying gravity in the sense that given the greenback's resurgence, we're seeing most Asia currencies succumbing to it. The yen is actually the top gainer, and this is coming against the backdrop of comments from the Prime Minister saying that he wants bigger wage deals than what we've been seeing this year. Paul.
All right, Avril Hong in Singapore, thank you. Let's turn our attention now to Nigeria's economy. GDP grew by more than expected in the third quarter, buoyed by a services sector that expanded at the fastest pace in almost 2 years. The economy grew at an annual 3.46% in the 3 months to September, and that was faster than the previous period. Bloomberg's Ondero Oganga has the details. So, Ondero, tell us more about this turnaround in the Nigerian economy.
Morning, Paul. So oil was one of the biggest drivers of this growth. It grew by 5.17%, and we saw oil production increase to 1.47 million barrels per day. This is attributed to a couple of factors. One, they were able to address security concerns and also legacy infrastructure issues. And to keep this momentum going, they're expecting a boost from the commencement of production of gasoline from the Aliko Dangote refinery in September, and also an increase in processing capacity of about 420,000 barrels per day. Also, new projects are expected to come online. And if we just stay with oil, President Bola Ahmed Tinubu is expected to present the 2025 budget in Parliament on the 27th of November. And they're working with estimates where they're assuming that oil production will increase to 2.0 million barrels per day, and the price will be $75 per barrel. If this happens, then it might be able to lift the economic growth. It will ensure that they have enough money to fund their budget. There'll be enough money to go around into different sectors like construction, hence injecting some form of activity, and we could even see expansion. It will also see that they have enough money in their reserves, and we could see the central bank intervening in the FX market. If we look at other sectors, non-oil grew by 3.37%, mainly driven by services, but agriculture slowed down to 1.1% because of heavy rainfall that washed away food that could have fed 8.5 million people for a period of 6 months, according to the United Nations. And this growth that they posted was slightly higher than the Bloomberg estimate because they had faster growth in agriculture than anticipated. But Bloomberg still estimates that in 2025, higher rates are going to subdue demand. And we are also likely to see the recovery in oil lose momentum. So growth for this year, because of that recovery in the third quarter, is expected to be about 3%, but come next year, it will average about 2.9%.
Well, we've got strong growth then, but we've also got very hot inflation in Nigeria. What's the thinking here for the central bank?
We're likely to see them hike rates by about 50 basis points. And if you combine this quarter and the next quarter, the hike would be about 100 to 150 basis points. And the central bank governor, Olayemi Cardoso, has always maintained that the bank is resolute in its effort to rein in inflation and also achieve positive inflation-adjusted rates. This way, they can be able to attract investment into the country and also stabilize the naira. And it's really great you spoke about inflation because it rose to 33.9% in the month of October. And there are a couple of factors that are affecting the outlook for inflation. The naira is weakening while the dollar is becoming stronger, and also that big budget is likely to undermine the efforts by the central bank to try and calm inflation in the country. If we also look at their currency, it sank to a record low of 1690 on the 18th of November, and it's likely to continue being under pressure as we go into the festive season. So we are likely to see the central bank seeking stability through portfolio inflows, which can be driven by further hikes in rates, and this is just reinforcing the case for the central bank to hike rates.
All right, Bloomberg's Ondero Ogonga there. So for a closer look now on the year-end outlook for Middle East and African economies, let's get to Ebru Pakcan, head of Middle East and Africa cluster at Citi. Ebru, thanks so much for joining us today. I do want to start in Nigeria, if we can. Ondero describing there the situation with inflation, something that is a big job for the central bank there. When do you see relief coming for inflation in Nigeria? It's currently running above 30%.
Yes, hi. Good morning, Paul. Over the last 12 months or so, since the president has been making various changes in his cabinet, we've actually seen the central bank taking very decisive actions on the monetary policy. Obviously, in Nigeria, the FX market is crucially important. And if you look at what they've been able to achieve in terms of the reforms over the last 12 months, it's actually really encouraging to see. The challenge, as you say, is now going to be to try to think about when and how to start monetary policy easing while managing the inflation. Given the trends in inflation, it is likely that there is going to be continued interest rate hikes. But going into 2025, probably by second quarter or so, we might start seeing some step backwards. It also really depends on what the US dollar rate hikes are going to be looking like.
Yeah, there are definitely some other factors outside of the central bank's control here, not just the US dollar, but also the oil price. And we've heard that the Trump team's putting together an energy plan. It's going to mean increased drilling, maybe more downward pressure there. What's the impact of this going to be on not just Nigeria, but also Africa's other oil-dependent economies?
Yeah, the trends around what the oil production, but also what the oil price might look like is one of the concerns going into 2025 for the oil exporting nations. If we think about Africa broadly, there are some markets which are more prone to the oil price risk versus others. I would probably name Angola, for example, as one of the countries where almost 90% of their GDP is dependent on oil exports, and therefore that's probably a market which is going to be more highly impacted. Whereas Nigeria, even though oil is again an important export commodity for Nigeria, actually the dependency is a bit less. It is a more diversified economy, so perhaps the impact there is going to be lesser. And of course, like we said, there are many dependents here in terms of growth in China and what the trends of that is going to be looking like.
Yeah, do you have an outlook for the oil price heading into year end?
I think for the year end, we are not necessarily expecting any major spikes upwards or downwards. But in 2025, our economists are forecasting mid-60s for crude oil.
Well, we do have a couple of other rate decisions in Africa this week. Ghana, Mozambique, potential here for more easing from both of those central banks. Is it a case here, though, of get your easing in while you still can?
Well, I think it's also following the trends that the Fed is setting for those economies, depending on what type of debt to GDP they are running. Like you said, Mozambique actually just recently announced a rate cut, not very significant, about 100 basis points or so. Ghana is expected to also do some rate raising, but one of the things that we really need to think about is that dynamic between inflationary trends versus the rate dynamics. In Ghana, the inflationary trends are in an improving direction, so therefore probably monetary easing is going to be more plausible.
Look, I also understand Citi, your employer, is setting up a regional headquarters in Riyadh. Can you tell us a little bit about some of the opportunities that you see in Saudi?
Well, yes, we have recently, successfully obtained a license to set up a regional headquarters in Riyadh. It's really a demonstration of how Saudi economy is growing and diversifying, and there's a lot of different reforms ongoing, both in terms of capital markets, but also development of other industries. We felt that it is time actually for us to broaden our presence and deepen our presence in the market. We are obviously seeing broad growth in Gulf countries. And we think, over time, in the next decade or so, we're going to actually see the Saudi economy increasingly become an important force
All right, Ebru, Pakcan, thank you so much for joining us today. Ebru is head of Middle East and Africa cluster at Citi. Still to come, Bloomberg has learned that Qualcomm's interest is cooling when it comes to buying rival chipmaker Intel. We'll bring you that scoop next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. Well, Bloomberg has learned that Qualcomm's interest in buying Intel has cooled. It upends what would have likely been one of the largest tech deals of all time. The complexities associated with acquiring all of Intel is believed to be the main hurdle. For more on this, Annabelle Drillers joins us from Hong Kong. So, Belle, tell us about some of the other hurdles that were in the way of this deal.
Yeah, well, it was certainly going to be a pretty difficult one to get across the line, it seems. But just to sort of step back and give some context. So Bloomberg back in September reported that Qualcomm had made a preliminary approach to Intel. That was at a point where Intel had just released a very bad set of earnings. They'd given a weak forecast. They'd made headcount reductions. So the company, it was just another signal that it wasn't really in great shape. But we've actually got an update on the possibility of that going ahead. And what we're hearing is that Qualcomm's interest in pursuing an acquisition of Intel has cooled quite substantially. It would have been one of the largest tech deals of all time if it had gone ahead. But as you pointed out, there were just a number of complexities fostering or facing this possible M&A activity, not least the fact that it would have had some regulatory hurdles, including possibly from China. This is a major market for both Intel and Qualcomm. And so there was a lot of difficulties possibly in facing it, really, to move ahead with it. So that's really the key reading from this. Again, it's all according to our sources at this point in time.
Well, Qualcomm's still looking ahead to new markets. What's the strategy now?
So what they've said, or the CEO sort of outlined, is that they want to make up an additional $22 billion in annual revenue by fiscal 2029. So they've kind of got a roadmap looking at the next 5 years for the business. They're looking at different ways about how they can go and do this. But essentially, what we're understanding is that they haven't really identified any large acquisitions at this point in time that would get them to execute on that $22 billion. But they could possibly be looking at new markets like PCs, networking, automotive chips. This is all about trying to add more to the bottom line.
All right, Bloomberg's Annabelle Drillers there in Hong Kong. Thank you. Let's take a look at some of the other stories that we're following. Nissan will reportedly reduce its US output by 17% through to the end of March. The Nikkei News says the extension of ongoing production cuts will affect plants in Mississippi and Tennessee. Nissan had already cut output at the two factories, which are now operating 4 days a week instead of 5. Billionaire Steve Cohen, who injected capital into golf's PGA Tour earlier this year, says he believes the group can find a way to reunite with top players who left to play for LIV Golf. Saudi Arabia's public investment fund started LIV as a rival to the PGA Tour, luring a number of big-name players and sparking a feud before the sides agreed to a deal which didn't come to fruition. Coming up, oil edging lower, hit by a rising dollar after President-elect Donald Trump threatens extra tariffs on America's biggest trading partners. We'll discuss the market next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. Oil prices remain under pressure after Donald Trump's threats to slap further tariffs on Canada, Mexico and China sent the dollar higher. Brent crude had already slumped almost 3% yesterday after Israel said it's potentially days away from a deal with Hezbollah. For more, we're joined by Wei Lun Soon, our oil and shipping reporter in Singapore. Wei Lun, plenty of catalysts here for the oil market. Let's start with the de-escalation of tensions in the Middle East. What sort of impact? We've already seen some impact. Is that all priced in now, or is there potentially more to come?
I think it takes a few days for traders to really pass what Trump is trying to do over here. But immediately what we have seen is the stronger US dollar. And that tends to go in opposite of what oil prices do, right? And so this is what we've been seeing weighing on oil prices today. And then further afield, we have the issue of Canadian barrels, like what's going to happen to those exports, exports of Canadian crude into USA. Those things still need to be worked out over the next few months, quarters at least. But these are the questions that the market is handling, trying to deal with this morning.
Yeah, the announcement of tariffs sent the US dollar soaring. We've got the dollar spot index near a 2-year high. What sort of complexities is this introduced when pricing oil?
Right. So we do have a lot of the oil producers producing oil, and they are traded in US dollars. So a stronger US dollar would definitely make crude more expensive for them to export. And these would weigh on how much demand there is for oil itself from these other countries. And so we're walking into a market that's already been quite weak on demand side. We have the issue of China's demand, which people have been hoping for it to increase, but this is not what we've been seeing. And also coming into Monday next week, December 1st, this weekend, we are expecting the OPEC, the oil producing alliance, to really come out and tell the market whether they're going to unravel some of those production cuts that they've been promising. But as it looks like now, the oil market is kind of weak, and they're caught on the back foot on whether they should continue on with these curbs on production.
Yeah, so where does this leave OPEC? Do they really have any choice now but to try and curb production?
We can speak on behalf of the alliance itself, but a survey that my colleagues have done with traders, with analysts, the majority of them think that there's really no choice for them to unravel some of those cuts, right? Because a lot of these oil revenues go back to these producing nations, and already at the current level for Brent at around $73, $75, it's really not already enough for them to meet some of those government revenues that they need in their coffers. So to have them move some of those barrels back into the market is just going to weaken oil prices even further. On the flip side, we do have American oil producing numbers, supply coming on. So the OPEC is really caught in a really sticky situation as of now.
All right, Wei-Lun Su, our oil and shipping reporter in Singapore, thanks so much for joining us. Now, debate over a potential US rate cut in December is ramping up as investors look ahead to the latest reading on Wednesday of the Fed's preferred price gauge. Minneapolis Fed President Neil Kashkari told us what key factors he's watching for.
Right now, we know that inflation is somewhat above our target. It's running at around a 2.5%, 2.6% run rate right now. I have some confidence that it's gently trending down. And right now, the labor market remains strong. The question in my mind, the biggest question is, where is the neutral rate environment? You know, we've had relatively high interest rates relative to the prior 10 years. And the U.S. economy has continued to grow with great resilience, and the labor market has been resilient. And so how do I reconcile the fact that the policy rate has been relatively high and growth has been sustained? That suggests to me that perhaps the neutral rate environment is higher than it was in the past, and that perhaps monetary policy is not putting as much downward pressure on the economy as I would have expected. And so this is what I'm trying to understand right now, is how much downward pressure are we putting on the economy, and what is the path for inflation? But right now, knowing what I know today, still considering a 25 basis point cut in December, it's a reasonable debate for us to have.
Why not pause? You talked about how resilient the economy is. You talk about how resilient the labor force is. You talk about how resilient all the factors are. And add to that, we have, this rally in the stock market. Why not just pause?
Well, you're making good points that would argue in favor of not cutting rates. On the other hand, if I look at the underlying components of inflation, goods inflation has fallen all the way back down to pre-pandemic levels. Services inflation is trending down, and that's tied to wage growth, and wage growth is slowly trending down. And what's left is housing inflation. housing inflation is still high. But if we look at forward leading indicators of where housing inflation is likely going, and that's the inflation of new rents, that new rental inflation has already come back down. So that suggests that housing inflation ought to come back down. Ultimately, we want to get inflation back down to our 2% target. We're not aiming to undershoot it. And so we do have to make some judgments about what is the path ahead for inflation. And that's going to be an important determinant on what we do with monetary policy.
That's Minneapolis Fed President Neil Kashkari speaking with Insight anchor Haslinda Amin. Let's take a look at how futures are tracking ahead of the US Open. Modestly, very modestly positive territory. We've got a dollar spot index near a 2-year high. Of course, we have had this threat from incoming President Trump of an additional 10% tariff on goods with China. That's on top of any other tariff that he decides to implement. He's also putting tariffs on Mexico and Canada of another 25%. All right, that is it for the first hour of Horizons Middle East and Africa. I'm Paul Allen in Sydney. Do stay with us for the second hour of the show. Jennifer Zadasaja will be joining us from Johannesburg. This is Bloomberg.
This is Horizons Middle East and Africa, our top stories this morning. President-elect Donald Trump vows to impose additional tariffs on China, Canada, and Mexico, saying they need to clamp down on migrants and illegal drugs. The dollar rises and Asian stocks drop on the prospect of an additional 10% levy on Chinese goods and 25% on North America's regional neighbors. Plus, Israel and Hezbollah are inching closer to a ceasefire deal that may be concluded in the coming days. In the meantime, the two sides continue to fire artillery and rockets. Good morning. It has just gone at 9 a.m. across the Emirates, 7 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg. Welcome to the second hour of Horizons Middle East and Africa. And really the big story of today are those potential tariffs that we did get from Donald Trump reverberating again across the markets. If we just take a look at where we're at right now, it's proving to be a risk-off day as the markets react to that news from the president-elect, but not before Monday, which did see a positive day for U.S. small caps. Clearly, we're seeing the Russell 2000 down, though, right now. The Bloomberg dollar, though, trading in the green, which is significant because we are seeing the currencies of those countries that are targeted by Trump, including China, Mexico, and other trading partners, weaker. Right now, the Bloomberg dollar up just about 0.2%. The U.S. 10-year we have on the board as well. It's little changed right now at about 4.29% there, but it did end Monday lower than the 2-year note. That was the first time we saw that move since early September. We're seeing the news that Trump nominated Scott Bessent as the next Treasury Secretary, sparking a rally broadly across the bond market with long end yields leading those gains. The 2-10 curves also inverted again for the first time since September, as we mentioned there. And we also have Brent crude on the board up about 0.4%, just over 73.31 cents a handle, with the price action really following the news of a potential Middle East ceasefire. We also received word about that OPEC Plus meeting that's coming up in just a few days now being online. But I do want to bring you this chart over here. We're mentioning the significance of the impact of this potential tariff. And this is just a look at the three countries that are targeted. They make up over 40% of the U.S.'s total imports as of the second quarter of 2024, which is about $812 billion, just to understand the potential scale of this impact. But let's check in on how markets in Asia are faring, how they're potentially responding to the news. Ebru Hong is standing by in our Singapore studio. Ebru, what do you have?
Oh, well, Jen, it is mixed in the region as investors react to the tariff man, right? Trump's plans on these levies for its top trading partners. It's risk off. So we're seeing Japan, South Korea, Taiwan. Those are the markets that are underperforming. But it's really interesting to see Chinese shares managing to clock some gains on a day like today. Some of our colleagues have highlighted that turnover is low, so there's not much strength behind the gains. Others have attributed the expectations of fiscal stimulus now that we have this plan for China tariffs, that might be fueling some of the climb in Chinese stocks. I also highlight what we're seeing on the Nikkei today. It is the underperformer. And this is, as some of our colleagues have been highlighting on the MLive blog, you think about how Trump is essentially wasting no time in, quashing potentially these global trade norms. That's going to put further pressure on Japanese export-related names, particularly the ones with really high overseas exposure. And there's an added headwind today for some of these Japanese names in the climb in the Japanese yen. And this is following on from Prime Minister Ishiba's comments on wages. So this is what you're seeing for now in the Asia Pacific. Jen?
Thanks so much, Ebru Hong in Singapore for us. We'll check back in with you in just a bit. Let's go back to our top story, though. President-elect Donald Trump has threatened more tariffs on China, Canada, and Mexico, citing concerns over migrants and illegal drugs. Let's bring in our chief North Asia correspondent, Stephen Engel, who is joining us. So, Stephen, this came as quite a surprise for the markets. We anticipated this may come. But what do you make of the timing of this and also the scale at which Trump is saying he will impose these tariffs?
Well, I think the president-elect is wasting no time also to get that threat out there. We all know, and we've talked about it ad nauseum, about the pledge of 60% tariffs on Chinese goods all across the board once he takes office. And he says tariffs will be at the top of his agenda as soon as he does take office on January 20th. But there's been a little bit of measured dare I say, optimism that perhaps that 60% threat could be negotiated down with the Chinese. He's just getting a jump on that as well to say that he was going to add 10% tariffs on Chinese goods if China does not respond in the way that he is hoping on the issue of fentanyl. Now, fentanyl is something that China has never admitted that it is supplying to the United States or even through Mexico. Xi Jinping did agree with Joe Biden at the sidelines of APEC in San Francisco to essentially work together to battle the supply chain of precursors to that drug. But again, China has said it has been doing everything it can in those commitments. But Donald Trump says it's not enough. 10% tariffs on top of the 25% tariffs that are already in place on $300 billion worth of goods from China to the United States, and on top of any more additional tariffs that he's pledged on the campaign trail, up to 60%. So we're talking perhaps much more than that. But again, that could be negotiated down. So the more interesting part of this, perhaps, since we've already been prepared up here for the tariffs on China, is his pledged action against his two closest neighbors, Mexico to the south and Canada to the north, saying there'll be 25% tariffs on day one in an executive order if Canada and Mexico do not do their part in securing the borders and also preventing the illicit trade across those borders of illegal drugs like fentanyl.
Right. Still waiting to hear the reaction from a number of leaders. Our chief North Asia correspondent, Stephen Engel in Hong Kong, starting us off. Stephen, thanks so much. Let's continue on with the story. Donald Trump has roiled markets with a threat to curb global trade flows with tariffs on all products from Mexico and Canada. For more on the market reaction, let's bring in Bloomberg MLive strategist Mark Cranfield, who's joining us now. Mark, we mentioned the currencies are having quite a reaction, of course, the dollar, but also some of these other countries that are affected. What would you say, though, is moving the most post this announcement?
Well, we're living up to the fact that we realize that when Donald Trump gets back in to the White House, people who can remember 4 years ago, it's a headline fever time for foreign exchange traders, and we're getting our first dose of that today. It's a bit of deja vu for people who were around during his first administration. In Asia especially, we were getting bombarded with these headlines of whether it's about trade tariffs or other matters. They would often come early in the Asian session, and we got a big taste of that today. Is moving the currency markets all over again. There's a lot of irony involved as well, because really Donald Trump has said before that he actually really prefers a softer US dollar, not a stronger one, but actually he's getting a much stronger US dollar because of the initial reactions to this, whether it's the yuan getting weaker, the Canadian dollar, the Mexican peso. They're all reacting very negatively, and traders are using that as an excuse to buy US dollars. So he's not really getting what he wants in many ways. He's certainly roiling the markets. He's creating plenty of volatility. We can expect a lot more of it from January next year as well. So as one analyst recently said, if you're good at trading if you're good at trading headlines, you're going to love the next 4 years. And this is exactly what it's starting to feel like. Intraday and short-term traders are really in the best place. If you're a long-term trader, much more difficult.
And Mark, he hasn't even been inaugurated yet. I think we should remember. Let's take a look at what we've seen in treasuries, because on Friday we did mention the reaction in the bond market to Scott Bessent being named as Treasury Secretary. Have we seen a complete reversal, though, of some of those early moves?
Not a complete reversal, but certainly traders have been backing away from their initial thoughts yesterday. That first blush, when they took it to Mr. Bessent, they thought he was going to be a fiscal hawk, that he was going to help to restrain American spending. That would be good from a treasury market point of view, because it would probably help to keep long-term yields down a fair amount. 30-year yields dropped quite significantly yesterday. We're starting to see some of that dialed back, because it looks as though, in certain respects, Donald Trump is overriding some of the things that Mr. Bessent had to say yesterday. So there's a conflict here, and traders don't like it. When they hear people from the same administration, whether it's central bankers and finance ministers or whoever it is with a lot of authority, when traders see us with a conflict between some of the biggest voices on the same team, supposedly, they will take defensive action. In this case, it's bond yields starting to go a little bit higher. So even though equities are pretty soft, we've seen a sell-off in S&P markets. It has recovered a little bit, but we did see some pretty big weakness in the European futures as well. And that would normally be a haven bid for treasuries. We are not seeing that. So you can tell that the bond vigilantes are not in full force yet, but clearly they're watching very carefully what Mr. Trump has to do.
Yeah. Bloomberg MLive strategist Mark Cranfield, great to get you on this morning. Thanks so much for joining us. Now, still ahead, Israel and Hezbollah are inching closer to a ceasefire deal that may be concluded in the coming days. We have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, Bloomberg has learned that Israel and Hezbollah are inching closer to signing a ceasefire deal that may be concluded in the coming days. But the two sides continue to fire artillery and rockets at one another. Israel's Security Cabinet is expected to vote on an agreement later today. For more on this, Bloomberg's UAE Bureau Chief Dana Quraish is joining us now from Dubai. So, Dana, what do we know so far about the ceasefire deal and where the gaps still are from the sides?
Good morning. Yes, we know that it is becoming very likely that Israel would agree to a ceasefire agreement with Lebanon, particularly Hezbollah. We know that the cabinet, the Security Cabinet, is meeting tonight, and that there will probably be an agreement. Now, this has come almost 2 months after negotiations have started. We were here about a month and a half ago in October when Israel agreed to a U.S. and France proposal for a ceasefire agreement, and then we saw Israel not backing this deal. So there could be some sort of, backing out of the deal by Israel. There is some opposition among Israeli officials to that deal. So we want to be cautious, especially in the Middle East. We saw a lot of negotiations for ceasefire falling, not collapsing and not getting where we want. So there is a likelihood the ceasefire agreement will take place. It's a 60-day ceasefire where initially Hezbollah has to withdraw from the border, which is the Litani area, from the border with Israel, and seeing the Lebanese army and UN peacekeepers deploy there.
And Donna, we know in the past there have been disagreements, obviously, about some of those terms you just mentioned. Are we likely to see some of those disagreements collapse this potential for an agreement now?
I mean, it's hard to predict that, right? There were things that Lebanon wasn't 100% sure of, the Lebanese officials, and then they eventually agreed to it, which is, of course, Israel's right to defend itself in case there is a violation. So reports said the agreement now has that clause in a way that also guarantees Lebanon's right to defend itself, but that Israel would do that as well, meaning strike Hezbollah infrastructure or strike Hezbollah group if they see a violation of course, the UN Security Council Resolution 1701. Other obstacles could be from Israel's side, because Lebanon, as you know, is completely very much desperate. Lebanon and Hezbollah as well. They've been under massive pressure, including on strikes on their infrastructure, missile storage, and all of that. They are in a very critical point, and they probably want the ceasefire more than Israel.
Donna Quraish, Bloomberg's UAE Bureau Chief. Donna, thanks so much for joining us. Now, on the ongoing Lebanon and Gaza conflicts, they're heavily weighing on the Israeli economy. Israel's central bank has left interest rates unchanged at 4.5% as it weighs a war-related economic slowdown as well as quickening inflation. Israel's currency has advanced as optimism builds around a ceasefire with Hezbollah in Lebanon. Joining us now is Shmuel Abramzon, the chief economist at the Israeli Finance Ministry. So, Shmuel, thanks so much for joining us. Let's just start here. Is your expectation that this war and the prolonging of it will continue to hurt the economy? What effects do you see the continuation of this conflict having on the economy?
So, good morning from Jerusalem. First of all, we do expect the conflict to wind down, and our base scenario actually expects a renewed growth next year. We expect above 4% growth next year in our baseline scenario. According to what we also hear in the news, this is probably a very realistic scenario. So after a quite tough year for the Israeli economy, which we weathered well, but still, of course, had its tolls, we do expect a new positive year.
What is giving you that optimism, Shmuel?
We can see it through various indicators. We can see the way investors see the Israeli market. We've seen that in the past year, our stock exchange has been, stock markets have been trading at record levels. We've been seeing an increase of roughly 20% in the prices of stock markets. We've been seeing in recent weeks a lowering of our spreads, lowering of the CDS, and we can see all the indicators supporting this very positive outlook. We can see it. You mentioned the currency, so the Israeli shekel, the currency is trading at stronger levels than it has been on the eve of the war and so forth. So there's a bunch of indicators that support this view.
What would be potentially a risk, though, to that view, Shmuel? We mentioned how there have been false starts in the past for resolving this conflict. If this conflict, in fact, does continue, could that be a risk to this renewed growth that you're seeing for 2025?
Absolutely. Absolutely. It will all rely and almost solely rely on the way things end up on the security front. There's still issues need to be done and agreement need to be dealt with. The situation with Gaza, there's the issues with Iran. Of course, there's many other question marks beyond the situation with Lebanon, which we hope will also be resolved. But there is still substantial uncertainty that needs to be resolved.
What do you think for an investor, from an investor perspective, the uncertainty that is still not resolved? Is there something, messaging perhaps from the government, that could give investors renewed confidence and optimism like you have?
Absolutely. So as we've been seeing over the years, the Israeli government has been very, very keen and very dedicated to fiscal responsibility. And we see that same story this way. These days, the government has just approved a budget for 2025, still yet to be approved at the parliament. But the base scenarios, the base figures, the forecasts and the basic planning suggest a deficit that will stabilize our debt to GDP and will eventually enable the debt to GDP go back to its previous levels. So that's a very key component of our policy to fiscally conservative. That's one thing. And then there's a bunch of fundamentals, very strong fundamentals that we've seen already in this past year that supported our ability to this crisis, this war, substantially, despite the very substantial needs of financing. We have a central bank with ample levels of foreign reserves, for example. We have a very strong financial base and so forth.
But you mentioned the budget, Shmuel. Do you believe that it can actually pass Parliament? I mean, that's one of the concerns here. And if you say that is contingent on renewed optimism, is it possible that we see some conflicts in Parliament to actually getting this over the line?
We are definitely positive that it will pass in the Parliament. Naturally, the parliamentary process is always somewhat tough with negotiations, but we have confidence that it will pass fairly similar to the way the cabinet has proposed. Yes, at the end of the day, this is a coalition parliament that the cabinet, the government, has quite strong control over.
And then finally, Shmuel, I mean, your expectation for the credit rating for Israel. Again, you're quite optimistic about what 2025 can hold for Israel. Do you expect the credit rating to reverse itself from some of the downgrades that we have seen?
Well, eventually, yes. I don't know when it will happen. This is the credit ratings decision, of course, and they will evaluate as they do all the time. But eventually, yes. I think that definitely, at least for some of the credit rating agencies, the scenarios they put weight for, high weight, heavy weight, did not fulfill and are not expected to fulfill. So I think that definitely in the medium run, we will see improvements also on that front.
All right, we have to leave it there. Thank you so much, Shmuel Abramzon, the chief economist at the Israeli Finance Ministry, joining us there from Jerusalem. Now, coming up, Zimbabwe's chief debt negotiator says he's determined to clinch a restructuring deal before the end of his term at the African Development Bank. We'll discuss the prospects for an agreement next. This is Bloomberg. Debate over a potential U.S. rate cut in December is ramping up. Minneapolis Fed President Neil Kashkari told us what he's watching for.
Right now, we know that inflation is somewhat above our target. It's running at around a 2.5%, 2.6% run rate right now. I have some confidence that it's gently trending down. And right now, the labor market remains strong. The question in my mind, the biggest question is, where is the neutral rate environment? You know, we've had relatively high interest rates relative to the prior 10 years. And the U.S. economy has continued to grow with great resilience, and the labor market has been resilient. And so how do I reconcile the fact that the policy rate has been relatively high and growth has been sustained? That suggests to me that perhaps the neutral rate environment is higher than it was in the past, and that perhaps monetary policy is not putting as much downward pressure on the economy as I would have expected. And so this is what I'm trying to understand right now, is how much downward pressure are we putting on the economy, and what is the path for inflation? But right now, knowing what I know today, still considering a 25 basis point cut in December, it's a reasonable debate for us to have.
Why not pause? You talked about how resilient the economy is. You talk about how resilient the labor force is. You talk about how resilient all the factors are. And add to that, we have, this rally in the stock market. Why not just pause?
Well, you're making good points that would argue in favor of not cutting rates. On the other hand, if I look at the underlying components of inflation, goods inflation has fallen all the way back down to pre-pandemic levels. Services inflation is trending down, and that's tied to wage growth, and wage growth is slowly trending down. And what's left is housing inflation. Housing inflation is still high, but if we look at forward leading indicators of where housing inflation is likely going, and that's the inflation of new rents, that new rental inflation has already come back down. So that suggests that housing inflation ought to come back down. Ultimately, we want to get inflation back down to our 2% target. We're not aiming to undershoot it. And so we do have to make some judgments about what is the path ahead for inflation. And that's going to be an important determinant on what we do with monetary policy.
This is Horizons Middle East and Africa, our top stories this morning. President-elect Donald Trump vows to impose additional tariffs on China, Canada, and Mexico, saying they need to clamp down on migrants and illegal drugs. The dollar rises and Asian stocks drop on the prospect of an additional 10% levy on Chinese goods and 25% on North America's regional neighbors. Plus, a booming services sector sees Nigeria's economy grow faster than expected in the third quarter. We have more on that in a bit. Good morning. It is just gone 9:30 a.m. across the Emirates, 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg. Welcome to the second hour of Horizons Middle East and Africa. And the markets really reacting to what we heard from President-elect Trump. As we can see on the board here, what we saw on Monday, though, U.S. equities ended the day slightly higher. Right now, we're seeing U.S. futures little change, but the Russell 2000 hit a new record high on Monday after retreating a bit to the close. Right now, we're seeing some downside. The 10-year yield is also up here on the board. It is little change right now at about 4.29%. But Monday did end lower than the 2-year note. Its first time doing that move since early September. We also have Brent crude on the board up just over 0.2% there at about $73.21. $73.21 a handle. This is coming after news of a potential Middle East ceasefire agreement, which pushed the commodity lower. We also heard from OPEC Plus on Monday announcing that it will hold its next meeting online. And an Iranian official actually told a state-run news agency that there's little scope to increase production. And next year, we'll likely see an oversupplied market, which we've been talking about for quite some time. Also have the Bloomberg dollar up here, rebounding strongly on that Trump tariffs news, up just over 0.2% there. That also sending currencies of China, Mexico, and other trading partners weaker now. And I want to bring you this graph here. The three countries I just mentioned there make up over 40% of the U.S.'s total 812 billion imports as of the second quarter of 2024. Just to give you some impact and potentially understand the scale of what those potential tariffs could impose. This is just a look at some of those countries. Potentially, if we do see more of that reaction coming, we could see even greater impact going ahead further. Let's check in, though, on how markets in Asia are faring. Avro Hong is standing by in our Singapore studio. Hey, Avro.
Hey, Jen. Yeah, Asia shares are mostly lower, except in China. Slight gains there. But I also wanted to highlight what we're seeing in the currency amid the greenback resurgence. The renminbi is getting hit as well. It's squarely in the crosshairs of Donald Trump. And it's really interesting to see how Chinese authorities have recently been seeming to ramp up support for the currency via the yuan fix. If you look at the fix today versus the traders' estimates about 400 pips, it's not a lot. But versus where offshore yuan had been trading up about 700 pips, that seems quite aggressive. And some of our colleagues, we have MLI's Mark Cranfield already highlighting that the last thing that China wants to see when it's trying to stabilize the stock market is a renminbi in free fall. So keep that in mind as we see the support from the PBOC on the Chinese yuan. Aussie also in focus, steep losses earlier, pairing some of that now. This is, of course, an economy that has its fate closely tied with China. Jen.
Avro Hong in Singapore. Avro, thanks so much. Now let's switch from Asia to Africa. Zimbabwe's chief debt negotiator is pushing to clinch a restructuring deal before his term as president of the African Development Bank concludes next August. He was responding to Bloomberg questions at a debt conference held with creditors in Harare. Let's speak with Bloomberg's Ndiro Oganga, who has been following this story. So Ndiro, tell us more about the situation and what we heard.
Morning, Jen. So Dr. Adesina is hell-bent on ensuring that this restructuring is done by the time he leaves office. However, he has his work cut out for him. If we look at Zambia, it took 4 years for them to get a deal, which goes to show that these talks can be painful, long, and tumultuous. But he's determined. He says that we need to get Zimbabwe to a good place before the end of his tenure. And it's really important because he was speaking at a debt conference where creditors were there to mean that some lessons could be exchanged, some headway could be made. And he also said said that AFDB may tap into the Africa Development Fund, which is always used to help clear arrears for vulnerable countries. This has been done for Somali. It has been done for Sudan also. And they're going to place a request to have it set aside during the Africa Development Bank's 17th replenishment to allow for resources to be made available to help Zimbabwe clear its piling arrears that has been mounting for years. The president also says that the country is currently in negotiations with IMF for a staff monitored program. And this is crucial because it's a very necessary step in the debt restructuring talks. The only downside to this is that these programs come with very tight reforms which are likely to affect the vulnerable people of Zimbabwe. This is a country that is grappling with low wages, inflation is high, their currency is not stable, unemployment is high, and now drought has ravaged them and there isn't enough food in the country. The import bill is really, really high. So the government will be working, even as they're looking for this program, to ensure that their vulnerable people are protected.
Right. And what exactly, Andiro, are we hearing from the government in regards to this debt restructuring? You mentioned the difficult situation that the country is already in. What can the government do? What are they looking to do?
Jen, the first step will be reimbursing white farmers who lost their land in the year 2000, $331 million. And as a sign of good faith, about $35 million has been set aside and payments are set to begin this year. And this debt restructuring is very crucial because the arrears have been mounting since Zimbabwe defaulted and they've been locked out of the international market. As a result, they're not able to borrow from multilateral lenders such as the IMF, and they're forced to resort to their central bank to fund their borrowing needs. This has put a lot of pressure, funding inflation, and also jeopardized all the efforts that they've tried to put in place to have a stable local currency. So that is why we saw the government enlist the help of the Africa Development Bank, and they want to get these talks done. They want to get it out of the way. And Dr. Adeshina has likened this mounting arrears to trying to run uphill with a backpack full of sand. It's a really, really difficult task. He says it's high time that this anomaly is cleared and Zimbabwe is given a new lease of life, not just the economy, but the people of Zimbabwe.
Bloomberg's Andiro Ganga joining us from Kigali on Zimbabwe. Andiro, thanks so much. And now let's turn from Zimbabwe to Nigeria. And joining us now is Bongo Adi, who is a professor of accounting, economics and finance at the Lagos Business School, to talk to us about the expectations that we were expecting with Nigeria's GDP and what we actually got. Bongo, thank you so much for joining us. Give us your initial reaction to this print that we got. It rose more than most economists expected. Are you in that camp that was surprised as well?
Yes, I am really surprised. Not just me. A lot of people, many economists and many observers of the economy in Nigeria are really surprised because if you consider the other macroeconomic indicators, be it the interest rates, which has been very high and hampering investment in the real sector, or the high level of inflation and unstable exchange rate is also very high, which has actually constrained, producers. So it would be difficult. I mean, it's really a surprise that the economy turned up at the level that they gave it, 3.44% or thereabout, which shows that the economy is resilient. But then I think what's happening is that some sectors which have low, employment potential and capacity driving the growth, such as transportation and of course financial sector, which has always seemed to have not really been connected strongly with the rest of the economy because it seems to perform in opposite direction. But manufacturing, the real sector has not done so well. So that is what we observed to the recent GDP figures.
Do you attribute any of this to some of the reforms that we've seen from President Tinubu? We did hear him reacting after we got this print. Is some of this because of the difficult reforms that he instituted?
Well, yes, the reforms. I mean, there's a mixed result to the reforms. Agreed. Some sectors are beginning to backward integrate in order to find substitute to the imported products, which have come under very hard times as a result of the devaluation of the currency. But beyond that, even the finance institutions both the World Bank and the IMF seem to be in disagreement regarding the outcome of the reforms. Whereas the World Bank thinks that reform is working because government revenue has improved, so the fiscal deficit is beginning to somehow reduce. But the IMF seems that the reforms have not worked in any way. And then I think that has raised some issues with the presidency and other people, in the government. The government is facing a lot of criticism. Some people think that the challenge of the economy is more structural rather than monetary, but it seems that the approach towards it has been more of taking a monetary stand, a hawkish monetary stand actually. And the expectation is that when the Monetary Policy Committee meet again, that they're going to raise the rates, even though people think that it's not actually helping, rather worsening the situation in the economy.
Do you think that they should be raising rates? Because we've talked about how a number of African economies, or African central banks, are starting to ease or pause. Nigeria is the outlier here. What do you think the decision should be this week then?
Yeah, so given the level of inflation, which has started to, because there was a time 2 months ago, we started to experience some level of disinflation, but that seems to have been reversed as inflation has started to rear strongly, on. So the expectation is always, what they've always done, which is to raise the rates. But on the more conservative note, I think they should keep it where it is. But most of us believe that the challenges the economy is facing right now are not just driven by monetary factors alone. There are more structural elements to the challenges, and therefore the government should take a more robust approach rather than just approaching it from a monetary point of view. When you look at the monetary policy, the monetary policy rate, if you graph it, chart it against the real sector growth, so you see that there doesn't seem to be any sort of, they are correlated strongly. So as the inflation is going up or the monetary policy rate is going up, it seems that the economy is underperforming. So I think it's important for the Monetary Policy Committee. But again, they will look at the GDP figures. So they will claim that the GDP has resilient, therefore the monetary policy rate is working. But then we have to look at those sectors that are working, because those seem to be recession-proof sectors. The other risk sectors of the economy are not responding that much.
Right. And we'll obviously see what the decision is this week. Bongo Adi, Professor of Accounting, Economics and Finance at the Lagos Business School. Thank you so much, Bongo, for your insights this morning. Now, coming up, G7 foreign ministers are set to increase pressure on China for allegedly supporting Russia in its war against Ukraine. More from their meeting in Italy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, G7 nations are set to increase pressure on China for allegedly supporting Russia in its war against Ukraine. That's according to an early draft of the communique seen by Bloomberg as foreign ministers meet in Italy. Bloomberg's managing editor for European economy and government, Ben Sills, joins us now for more. So, Ben, what exactly can we expect from the meeting today? And tell us more about this draft that was seen.
Well, I think that the main thing we're looking for is the evolving position on Ukraine and the Middle East to a certain extent. What we've been seeing, we were in Rio last week for the G20. We have colleagues in Fuji in Italy this week for the G7 foreign ministers. And what we're seeing is a lot of countries are really shifting their positions, and really firming up their positions, actually, in anticipation of Donald Trump's arrival in the White House in January. And I think that's the context in which you need to consider this draft statement that we got yesterday, which as you mentioned, has the G7 really committing to firmer action on the Chinese companies that they see aiding the Russian war effort.
Are we anticipating any more escalation in terms of rhetoric, Ben, or is this really going to be the focus of this meeting with the foreign ministers?
Well, actually, I would say that we are already seeing action to back up that rhetoric. Last night, we had a late breaking scoop out of Brussels that the EU, which obviously makes up a large proportion of the G7, is proposing sanctions on a series of Chinese companies that they have found to be supplying the Russian military. So, we're already seeing action to back up those words, and it does appear that the lines are being drawn in ever more stark terms between the Western Bloc and those countries like China and, of course, North Korea, who are supporting Russia in its war against Ukraine.
Right. Bloomberg's managing editor for European economy and government, Ben Sills, joining us there. Ben, thanks so much for that reporting. Now, coming up, Thyssenkrupp's steel unit is planning to reduce its labor force by about 40% this decade. More on Germany's deepening industrial downturn next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, Thyssenkrupp's steel unit is planning to reduce its labor force by about 40% this decade, a move that would shrink a business that's lost billions of euros to a global steel glut and rising energy prices. It's part of the German conglomerate's broader overhaul, adding to a deepening industrial downturn in Germany. For more on this, let's bring in Bloomberg's Oliver Crook, who's in Berlin. So, Ollie, just how bad are things getting in Germany's industrial sector? We know you've been watching this quite closely and reporting on it. Give us some insight.
Yeah, Jen, I feel bad coming on air every day and really just giving very bad news about the German economy, but that has basically been the job for the last 2 years. And we talk about it in kind of the abstract when we look at the charts. We talk about German manufacturing PMI. Last time there was a positive print there was in July of 2022, I think. So we're talking about 2 years of manufacturing contraction in the German economy. That all sounds sort of theoretical when you see it sort of illustrated on charts and on paper. This is now the reality of what we're talking about. We're talking about thousands of job cuts. We're talking about tens of thousands of job cuts across the economy that have been announced over the last few weeks. Thyssenkrupp is just the latest one to announce it yesterday, talking about 11,000 job cuts, 40% of their workforce in their steel division being cut across the board. But that adds to what we heard from Bosch on Friday, 5,500 jobs. Ford, 4,000 jobs last week. Volkswagen, we don't have the figure yet, but this could be well into the 5 figures. So we're talking about a minimum probably of 30,000 job cuts over the last sort of month within the German industrial sector. And we're not talking about little companies. We're talking about sort of mainstays of the German economy. You know, Bosch, Thyssen, these have been around since the 1800s. Ford has been operational in Germany since 1925. So this is really very significant. When I talked to Carsten Breschke yesterday, the sort of chief macro analyst over at ING, talking about where are we in the cycle? Is this the beginning of the end? He thinks we're really smack dab in the center of it, that there are more job cuts to come. We got it from the suppliers. We got it from some of the auto manufacturers. We haven't heard anything yet from BMW, Mercedes. That could be coming next. And another sort of little piece of IFO survey we got a couple of weeks ago, just looking at that, the share of German companies that actually a fear for their economic survival has risen to 7.3%. That's up from 6.8% the month before in October. That's up a half a percentage point.
This is not what Germany needs ahead of the election, Ollie. How do you anticipate this could potentially affect what we do hear from lawmakers just going into the election?
Yeah, Jen, I mean, listen, you don't want to be the incumbent coming into this. You're talking about companies cutting 30,000 jobs just in the lead up to the election campaign. For Schultz and the SPD, this cannot be a very positive thing. It'll just sort of add to the narrative that they've managed to sort of mismanage the economy over the last couple of years. There's a couple of ways that this could play out. You could see it, for example, favoring, as you have a lot of fear in the German economy, some of the sort of Germany first parties, the AfD, the far right and the far left, Sarah Wagenknecht, that could favor them to a certain degree, but they don't really have the economic policy chops. So really, I think for many people, they're seeing this favor the CDU, and their sort of recipe for fixing the economy is a sort of traditional tax reform, cutting pensions, cutting spending, all of that sort of thing. Though that can help to a certain degree, what that fails to do is address the main problem that Germany has right now. It does not have the strong export markets that it used to have. The Chinese economy is slowing down. We're probably going to get some sort of tariff, at least discussions from Donald Trump. That will put the German economy in a very difficult position because their traditional form of just making really great products at the lowest possible price becomes a lot harder when you have those tariffs, when you have high labor costs in Germany, and when you have high energy costs. All of this a very sort of dangerous cocktail for the real sort of formula that has created huge amounts of wealth in this economy for the last few decades.
Appreciate your reporting there. Bloomberg's Oliver Crook in Berlin giving us the rundown there in Germany. Thanks, Ollie. Now, for a look at some other stories we're following, Nissan will reportedly reduce its U.S. output by 17% through the end of March. The Nikkei News says the extension of ongoing production cuts will affect plants in Mississippi and Tennessee. Nissan had already cut output at the two factories, which are now operating 4 days a week instead of 5. U.S. lawmakers say Hong Kong has become a center for financial crime as Beijing tightens its grip on the city. The heads of the House China Select Committee says 2020's Beijing-imposed national security law has shifted the city from a, quote, trusted global financial center to a critical player in the deepening authoritarian axis of China, Iran, Russia, and North Korea. The lawmakers have questioned whether the U.S. should continue its current policy towards Hong Kong's financial and banking sector. And finally, billionaire Steve Cohen, who injected capital into golf's PGA Tour earlier this year, says he believes the group can find a way to reunite with top players who left to play for LIV Golf. Saudi Arabia's public investment fund started LIV as a rival to the PGA Tour, luring a number of big-name players and sparking a feud before the sides agreed to a deal, which didn't come to fruition, but still waiting how that will play out. And let us look at where markets are right now ahead of the trading day. We mentioned that markets really still interpreting what we did hear from President-elect Trump on those tariffs. If you take a look, though, at U.S. equities, not doing too much, but we are still seeing S&P futures above that 6,000 print. We also did see U.S. small caps doing quite well on Monday, although we are looking at more of a risk-off environment now that we have heard from President-elect Trump on those tariffs. And just on that, we are seeing the dollar stronger, and also oil is in focus. Let's take a look at where Brent crude is right now. Brent crude just a bit stronger, about 0.3% there at 73.23. Also paying close attention to a potential de-escalation in the Middle East conflict. That is Horizons Middle East and Africa, though. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe.